Welcome to the lecture on Introduction to Life Insurance. So, basically we are going to talk about conditions for life insurance policies in this lecture, and we know that life insurance policies are very important part nowadays. People used to take these policies and normally the payment is made after the person's death basically. So, this is to so that the trauma which is there already with the family of the persons, so they can they get some amount, so that the unexpectedly loss of the persons and the inability to meet certain expenses because of the absence of the person, that can be taken care of. So, the difference between the life insurance and the life annuity is that in life annuity you are you are paying stipulating that it is the person is alive, whereas for the life insurance it is paid to the survivors after the death of the person who is insured. So, that is the difference. Life annuity pays to an annuitant whom the policy stipulates to be alive, whereas life insurance pays for the survivors of the insured upon his death. Now, so life insurance policy stipulates the death of the insured before paying any benefits. The insured would pay either a single premium or annual premium in purchasing that life insurance policy. So, he has to purchase that policy, and in that he may pay single payment, or he may pay the payment in annual terms. And there are different types of these life insurance policies, and in that you have the whole life policy, the term policy, and the endowment policy. So, we will talk about these policies one by one. Now, whole life insurance policy, this insurance policy is obligated to pay the face value of the policy to the survivors of the policy holder upon his death whenever it occurs. So, after the death the survivors of the policy holder, their family will be paid after his death, and benefits are usually paid at the end of the year in which the insured's death occurs. And in this case you may have the to calculate the net single premium, and in this case it is the sum of the mathematical expectations that face value would be paid to for the policy beneficiaries. So, you will have this expectation is nothing but you have the probability of that the insured will be dying, and with that you will be multiplying with the present value of the policy benefits. So, if you try to calculate for the whole life insurance policy, now in that case if you are talking about the single premium cases, so in the case of single premium, if you want to have a single premium, now in that case the AX, so that single premium AX, so that is net single premium is so your net single premium is suppose AX. So, AX will be, as we talked that it will be the summation of the QX, so that is V1 plus QX plus 1 V2, like that. So, it will be going and this way you are going to calculate the value of the AX. So, its present value will be there in that case. So, QX is, as we know that QX is found by the number of deaths divided by the number of persons who are alive. So, QX will be dx upon Lx, and that will be multiplied with V1 Similarly, it will be dx plus 1 divided by Lx, and then it will be multiplied with V2, and so it will be going like that. Then you can further find the values. So you are multiplying the numerator as well as the denominator with Vx. So you can write Ax. If you multiply the numerator as well as the denominator with Vx, it will be dx into v raised to the power x plus 1 divided by Lx into Vx. Similarly, dx plus 1 v raised to the power x plus 2 divided by Lx into Vx. So this way it will go. Now we know that dx into v raised to the power x plus 1, so that is becoming as Cx. So we know that dx into Vx plus 1, it is nothing but Cx, this commutation term that we have derived earlier. Now this becoming, and Lx into Vx is dx, capital Dx. So Ax will be this will be Cx, then Cx by dx plus it will be Cx plus 1 by dx. So it will be going like this, and the summation of these Cx is becoming Mx. So you can write this as Mx upon dx, because the summation of these Cx is becoming as Mx. So so in that case this premium, net single premium which should be paid for that value will be Mx upon dx. So taking that $1 as the value. Now if you are calculating for the certain face value of the policy, so for certain face value of policy, if you are taking something different, you will be multiplying this ratio with that f. So for certain face value of policy, say f, so your net single premium Ax will be basically f times Mx upon dx. So by using these mortality tables, if you have a certain face value, so this face value can be computed, that will be equal to f into Mx upon dx. So so if you can understand with certain examples, say like a person he has to calculate the net value of the single premium. So net single premium you have to calculate, and for whole life insurance policy, and of a person. Now this person is 49 years old and wants family to receive $2 lakhs. So okay, so that after his death. So suppose a person who wants to do the insurance, he wants to give a single premium. He is 49 years old, and he wants that his family should get $2 lakh after his death. So in that case, it's a single premium payment, and we know that in that case Ax will be face value is 2 lakh. So you will be 2 lakh, and then it will be multiplied with the factor Mx upon dx. So x is 49. So now you can refer to the table. You refer to the table 49. So 49 is in the end, and if you look at the Mx table, it is 2400.44. So it is here. So this will be 49. So, if you come to 49, it will be 2400.44 and then divided by dx. So, dx is coming as 8425.80. So, you can calculate this is so this will be 2 lakh divided by M49 by D49. So, this will be, as we calculated, it is 2400.44 divided by 8425.80. So, it becomes equal to 56,978.33. So, he must pay the premium of $56,978 now, so that after his death, the person, the survivor, or his family members, they receive 2 lakh of dollars. So, that is how this is the single premium. Now, the thing is that not every time you are in a position to pay this amount in a single stretch at one time. So, what you do is you like to pay this amount for a larger period of time, say for your whole life, like that. So, in that case what to do? So, that case becomes as we know that in that case you have a situation like the annual premium. So, you can pay the annual premium for the whole life basis. Now, in this case the single premium will be broken into the annual premium. So, single premium is broken into annual premiums that would be paid by the insured. Until his death. So, so it has it's something the case of the whole life annuity due. So, in this case you have to find these annual premium. So, this annual premium which you will be calculating for the whole life insurance, that is PX. So, for the it will be according to the formula, this AX will be PX into so this is a annuity due cases. So, it will be AX, that is double dot. So, that way you can calculate this AX into equal to PX into A double dot X. Now, PX will be basically AX upon A double dot X. So, as we know that this AX is, we have calculated, this is MX upon DX, and we have calculated this A double dot X earlier, that is annuity due for that cases. Now, in this case it will be NX upon DX. So, what we get PX as MX upon NX. So, this is basically for the annual premium which we will be paying, that is annual premium PX till his death he will be paying, and this is for $1 payment. So, this is PX equal MX by NX, this is for the face value of 1. If we have the face value for F, so for face value of F you will be having this annual premium equal to F into MX upon NX. So, you had earlier when you had to calculate for the single premium, it was MX by DX, whereas for the annual premium you will be calculating by the factor MX by NX, and that will be divided with the face value, that will be multiplied with the face value. So, Suppose for the previous problem where you had the single premium value was coming close to 56,900 or so. Now, in this case, if he is willing to go for the annual premium, then how much he should pay. So, for that suppose if the person can't afford the entire net premium in one payment. So, in that case he is going to have the value of Px, and Px will be for the face value, as we know that Px will be f into mx by nx. Now, in this case f is 2 lakh, mx was m49 and nx was n49. Now, n49 can be computed from the table, and if you look at the n49 values, it is 1,26,532.64. So, it will be 2 lakh divided multiplied by this is 2400.44 divided by 126,532.64. So, that way you can calculate these values, and it will be coming as 3794.18. So, basically what you see that for earlier cases where you had to pay 56,978 rupees dollars, which was quite a huge amount single time. Now, if he wishes to pay for the whole life, in that case he has to only pay 3,794.18 every year, so that he can be sure that after his death the survivor will be getting 2 lakh rupees. So, that is how it goes for such cases. Now, there will be another case for the M payment basis. So, basically what happens that the person wants to pay only for certain period, and then he does not want. So, that is known as the annual premium and M payment basis for M payments. So, that is means the insured person wishes to pay only M times. He will be paying so the number of premiums is limited to M. In spite of instead of paying till his death, he wants that he should pay M number of times certain premium amount, and then he should stop, and then after his death the benefits should be going to his survivors. So, in that case it is for the M payment basis. Now, the M will be the number for which the premiums will be paid, and it will be something like a case of temporary life annuity due. So, in that case you will have the situation like the temporary life annuity due will be, so this will be M. So, A double dot X M, that is for that M payments he will be doing, and M annual premium will be MPX. So, AX which basically will be MPX into then you have A double dot X M. So, that is how you have to calculate. Now, in this case MPX what you get for the M payments MPX will be AX divided by A double dot X. So, for M payments. So, So, now you have to simplify this expression. So, if you see that your MPX will be AX divided by a double dot X M. So, what you do is you have this expression MPX equal to AX upon a double dot X for M payments. So, you can further write it as AX can be written as MX by DX, that is what we have earlier calculated, and then this AXM. So, that we had earlier seen in the earlier lecture, this is NX minus NX plus M, and then it will be divided by dx. So, that you should refer the earlier lectures where we could not do that much of a derivation, but you can find it nx minus nx plus m divided by dx. So, it will, you can further write it as mx by dx into dx by nx minus nx plus m. So, if you cancel the dx out, you can write mpx, it will be mx upon nx minus nx plus m. So, this is for the $1 face value. So, for face value f, you will write mpx will be f into mx divided by nx minus nx plus m. So, this is how you are going to calculate the value in case of when you have to only pay for m payments and you want certain face value. So, suppose in the earlier example, again as you saw that when you have single payment, that time it is coming close to 56 or 57,000. Then if you have the whole life payment, it is coming out to close to 3,700 or so. Now, if you want to pay, so if the person, wishes to pay in 10 years, now in that case what happens that you will be finding this MPX, that is M is 10, so that is, and X is so that is 10P49. Now, this will be 2 lakh multiplied by MX, so M will be 49, and then divided by N49 minus N of 59. Now, you can refer to the table, and if you look at the table M49, so M49 will be 2400.44. Similarly, you have NX table is there. So, from here you can refer to the values, and you will get the values like 2 lakh multiplied by M49 is coming out to be 2400.44, and divided by N49 is 126,532.64 minus 60,095.41. So, this way you are getting 7,226.19, means the person is and this is for the 5% interest rate. Let us know that in that let us be sure about it, that this is for a certain interest rate R. If the R is changing, these values will all be changing. So, it means that if the person is willing only to pay for 10 years, assuming that after that he will not pay any premium, and then he has to ensure that after his death the family should get some amount. In that case, he must pay $7,226.19 for the next 10 years, so that he gets 2 lakh rupees in the end. So, that is what the case of the annual premium, which is basically you are giving only M payments. So, only M payment, after that you are not paying the premium. Then another case which becomes important is the deferred whole life policy. Now deferred whole life policy here basically what happens that it is based on the notion that the insured person will not die until certain period of time. So, and the net single premium of this policy will be basically determined by that. So, he will be it is assumed that he will be alive for certain period n, and in that case you are calculating the net single premium. So, that time for which it is thought that he will not die, that is known as deferment period, and the single premium which is calculated, that is denoted by n upon Ax. So, that is the n is the deferment period in that case, and it will be calculated as so this will be it is given like this. So, that will be dx plus n v n plus 1 and divided by Lx. So, basically what we had done, started with n as 0 in earlier case, where we had to calculate a single premium, it was dx by Lx into v v1. So, here you are assuming that for n years it is deferring the payment, after that he will pay. So, dx plus n by Lx into Vn plus 1, similarly dx plus n plus 1 Vn plus 2 divided by Lx, and that will go. So, in that case you have to compute the values. So, what you will get, you can further have dx plus n Vn plus 1 plus dx plus n plus 1 Vx n plus 2, like that, and in the denominator, as you know, it will be only Lx. Now, again in this case what you are going to do is, you are going to multiply with the term v raised to the power x. So, if you multiply in the top and the bottom with Vx, so it will be dx plus n and Vx plus n plus 1. Similarly, dx plus n plus 1 Vx plus n plus 2, and so on. And then since you have multiplied with Vx on the bottom also, it will be Lx into Vx. So, that is dx. Basically that we know that Lx into Vx, it will be Vx basically it is. So, it will be dx. Now, this summation will be m of x plus n. So, this will be mx plus n, and this will be divided by dx. So this n ax, this value basically will be coming as mx plus n by dx, and if you are going for the face value of f, so that will be the value of the single premium when it is deferred for n periods face value. So, suppose if you have to now see that you have to calculate these cases. Suppose one example is there that a person is 35 years age. Now, it wants to buy, they want to buy basically a $30,000 policy. So, now that will be activated only if she dies when she is 40. So, that will be activated only if she dies when she is 40 or older. So, what will be the single premium? So, what is single premium? Now, if in such cases a person who is of 35 years age and it wants to buy a 30,000 policy and it will be dying, so that will be activated only then. So, in that case the period of deferment is here 5 years. So, n is 5 years period of deferment, and in that case if you find the NAX, so it will be face values that is 30,000, and then it will be multiplied with mx plus 1 by dx. So, it will be m of 35 plus 5, that is 40 by d of 35. So, you can further refer to the table m 40 by d 35, and if you calculate these values you are going to get 30,000, and if you refer to the table it will be 2717.07 divided by 17369.06. So, basically you are getting 4692.65. So, this way you can calculate the net single premium when it is deferred for n periods, and you get these $4,692.65. So, we will also discuss about the different cases of different cases which fall under the insurance policies in our coming lectures. Thank you very much.